Welcome to Banrion Capital Management's What's the Alternative podcast. Join host Shana Orczyk Sissel, the queen of alternatives and founder, CEO of Banrion Capital Management, as she interviews leaders in the alternative investment space. Learn more about their firms, their passions, and about the many different ways investors can use alternative investments to add value in their investment portfolios.
Hello again, and welcome back to What's the Alternative podcast. My name is Victoria D. Bills, Chief Investment Strategist for Banrion Capital, and joining me today is Jamie Shulman, Managing Director of Meriwether Capital Group. Jamie, it's a pleasure to have you. So excited to have you on for the show.
Thanks, Victoria. Good to be here.
So Jamie, I'd love to first start off by talking about your background. You have over 20 plus years working in the private credit space. I'd love to learn more about just how you got started in this space. Walk me through your financial journey.
Sure, happy to do so. So I am basically a career banker and career lender. That's my background. I spent the greater part of about 28 years in commercial banking prior to forming Meriwether Group Capital. I spent a number of years with larger banks, all really in commercial lending. And I spent the last 8 years of my career in community banking, which really led me to see the opportunity with what ultimately became Meriwether Group Capital. I spent the majority of those years working with entrepreneurs, small businesses, those who needed growth capital to help them achieve whatever they were seeking, and I found ourselves in a good position to be able to help as many of those as possible.
Nice. And in terms of your focus and in terms of let's talk about a little bit about the private lending space and what were kind of some of the pitfalls that you saw when it came to small and mid-sized companies and where you guys position yourselves in the market.
Sure. So, the biggest kind of idea that came around forming this is really the what I saw in community banking and really in large banking too, which is this niche of small businesses that I saw needed access to capital that were just kind of on the edges of what banks like to work on. And that could be based on the bank's underlying credit policy or pricing policy or just kind of guidance and strategy. And, these borrowers that I saw were not bad borrowers. It just meant that someone needed to spend a little bit more time and attention with these kinds of companies, and they need to get paid for their risk too. And banks, as much as I, appreciate being in that industry for a long time, build these boxes. And if you fit in the box, as many business entrepreneurs know, then it's great. If you don't fit in the box, then it's not great. And so where do you go? And so that was the whole idea that we had when we formed Meriwether Group Capital. The other thing that we noticed is that in the world of private credit, if you want to borrow, let's say, $7 or $8 million or more, there's a number of borrowers or a number of lenders that you can talk to. However, if you're on the smaller end, let's say loan sizes 5 million or less, good luck. There's just not a lot of us out there. And so that was kind of the opportunity we saw, was these really small business credits. Ultimately we do loans between 500,000 and 5 million, but kind of in that space that was really being underserved. And so that's the opportunity that we saw, and we ended up forming a business doing just that.
That's incredibly impressive. And just to echo back some of the points that you were just mentioning, it's like I came from the venture capital world, and I can, like, a lot of our criteria when we were looking at companies was they had to have certain level of annual recurring revenue, or the team had to be fully built out. We also, for example, there were plenty of companies that I saw that were on the earlier side where they could have just needed a little bit of extra cushion or runway to get them through to that next step. And so they could be profitable. But unfortunately, that just never came to fruition because they weren't able to get to a small lender, or they couldn't access the banks, or couldn't find VC or even angel funding. Do you think that that's kind of a flaw in the system, that sometimes, depending on the lender, depending on the sector, perhaps the hurdle might be too high, or maybe it's kind of causing this delayed in terms of who is actually able to afford capital or who's able to receive capital in this world?
Yeah, that I think that's a very good point. And I'll start by just clarifying that the businesses that we work with, our borrowers, they've already proven themselves to the public to some degree. So these companies are typically either profitable or at least EBITDA or cash flow positive. So startups, pre-profit, pre-revenue companies, those are real tough. Those are tough for anyone, and those are really companies in need of, generally speaking, equity, not debt, is the form of capital to help them grow. But companies that have started to turn a profit, but maybe don't have the 3, 4, 5 years, of historical net income that a bank might be looking for, that are on high growth trajectories, those are the companies we look, because we can really dig in and understand, is the growth trajectory that they're on, is it sustainable? And what are the risks involved with it? And then how do you compensate the risk for structure, pricing, et cetera? And those are the companies we really like. I'd say that the majority of businesses that come to us have either maxed out their bank or their bank has maybe maxed out them, and they're looking for one more turn of EBITDA for what I would often call permanent working capital. So this is money to help these businesses take on a new product, new geography, expand a client relationship, or we're seeing more and more, actually in the last year, acquisition financing opportunities where there's a competitor they're wanting to buy out. But these are it can be tough for a bank to get their arms around, but we're willing to kind of dig in and really sit side by side with these entrepreneurs and owners and understand what they're looking for a little bit more deeply.
Yeah, no, and that makes total sense. And I'd love for you to just talk a little bit about some of the companies that you've already invested in through the Hero Fund. And maybe we can even get into a little bit of the investment structure of the Hero Fund itself.
Happy to. So Meriwether Group Capital is the manager of the Meriwether Group Capital Hero Fund, using very basic terms there.
Right, yeah.
The Hero Fund is our mechanism to go out and make loans, and we can talk about the Hero Fund more and its structure in a little bit.
I think I would actually also love if you could, why Hero Fund? Why Hero Fund, or why the name Hero Fund versus any other name?
So we founded the Meriwether Group Capital Hero Fund, somewhat based on the hero's journey and the entrepreneur's journey, which we recognize is a tough road. And people who have the gumption to go out on their own and set up a product or service, that's tough. And we consider these people heroes, which is why we called it the Hero Fund. And so since we launched the fund, which was in April 2022, we've made, I think, 20 transactions to date. These are either new loans to new borrowers, or we've done some increases to existing ones. We've also had, I think, 3 successful exits during that period of time. So we're really excited about the portfolio we built up. These companies, just to give a little bit more color around them, are all operating entities. So we don't do real estate loans per se, although we might take real estate as collateral. These are all companies with a product or service. Geographically, since I'm here in Portland, Oregon, we're really Pacific Northwest centric. Most of the businesses we work with to date have been on the West Coast, but we'll go anywhere. These are companies, in a lot of cases, that make stuff, which we really like. So we like companies in manufacturer, wholesale, distribution space. We can more easily understand their cash flow and sales cycle and get comfortable with how that works. Things that we stay away from are companies that we don't easily understand how they make money or how they're going to pay us back. The average loan that we've done to date is about 1.5 million. The average duration is about 18 months. So we typically serve kind of like a bridge for something else, with something else being either a refinance of the balance sheet with a more traditional lender or an equity raise, or maybe even sale of company. So that gives you kind of a flavor for the types of businesses we work with. A couple of examples, we have lots of good success stories. I'll share maybe a couple. I can, go as long as you want.
No, please. Love that.
One of the companies we work with that's here in Oregon is a company called Sackcloth and Ashes. They're based in Salem, Oregon, capital of the state of Oregon, and they make blankets. So think, high-end blankets. Their biggest retail partner is REI. So if you're in a city that has REI, you can find them in their stores. They also have a really robust direct-to-consumer platform. We really like this company for a couple of reasons. One is it's really mission-driven. So this is not why we made the loan, but for every blanket that you buy, they also donate another one to a homeless shelter. Here in the Pacific Northwest, this is a huge issue. It's really a huge issue in all, many metro markets, but we see it here day in and day out. So it's a really cool story there. And there's a story of homelessness tied to the founder. Their biggest supplier, or their biggest buyer, approached them about a year ago and doubled their most recent order. So if you're a company that your biggest client wants to double what they're doing with you, how do you fund that? And while they had a banking relationship, that's a pretty dramatic change. So they came to us and we were able to kind of understand a little bit more of what they were looking for. And we structured a loan to really help them tie themselves to one specific client of theirs. And we've actually done a second transaction with them as well. So it's a really neat story. We have a good relationship with the founder and the owner. And I think it's a great success. And, this is really one of those things where it's good for the borrower. They appreciate the access to capital. It's good for our investor, which we can talk about a little bit more later. And, these are the kinds of small business entrepreneurial loans we want to be working on.
No, I think it's an incredible story. And in terms of providing blankets again for homeless shelters, and especially we're entering into the winter season, it just shows how much more impactful their business is. And do you have would you say that you have a favorite company? Not to say that there are favorites in your portfolio, but maybe one that or one that was also another let's hear another compelling case as well.
Sure. So I will definitely, you will not pin me down. I will not pick a favorite, because if I don't say them, the borrower will hear this and will call me and say, why am I not your favorite? So I'm not going to do it. But I'll give you another success story that I really like, which is so we do mostly companies that make stuff. However, we'll do other service companies. And we have one loan out to a restaurant group. And I would share with you that restaurants are difficult to lend to. My banking days, I probably did 2 loans of these in 25 plus years. Really hard. They're either too small, kind of a mom and pop, or they're too big, a national chain that really doesn't need a bank like one that I would work for. So a company that we do work with is called Pro West Restaurant Group. They operate 11 Latino and Mexican restaurants here in the Pacific Northwest. So they have a really diverse revenue stream. They've added on a couple locations recently, one in Southern California, and they're opening another location here in the Portland metro area. Actually, it just opened a couple weeks ago. I love this company because, number one, they did very well during COVID, which is very difficult for a restaurant to say that. They have an incredible loyal following. The primary restaurants that they operate are called Margarita Factories. They also have another brand called Dos Salas, which is a little bit higher end brand. It's a minority owned brother and sister run company, which also I really like. And so they have a diverse revenue stream, history of good success, but that's difficult for a bank to get their arms around because of the industry and the growth trajectory they're on. And they would like to add more stores over the coming years. And so we were able to step in and help them open the last couple of restaurants that they've started. But we can rely upon the whole group of restaurants as our source of revenue to repay our debt. And, I would say with both of those, the owners and the entrepreneurs, we're really close to them. So when we do a loan, we don't just kind of book it and forget it. First of all, we're collecting financial reporting pretty much monthly with all these borrowers. So we stay, and we know how they're doing on a recurring basis all the way through maturity. But then beyond that, we really try to be in that kind of circle of trusted advisors for entrepreneurs. So we're there to help them with other areas of mentorship that they could need. So, with all these businesses, I would say, no less than quarterly are we having really meaningful conversations about how is the business going? How can we help? What are other things that we can maybe introduce, or who can we introduce them to that can be helpful? And, these guys, it's our goal, frankly, with all these borrowers, that when they have their, key point of success and maybe sell the business, we want to move them over from that side of our balance sheet to really the investor side, so that we can help them, or they can help us help more entrepreneurs just like them.
Yeah. And I honestly, I love hearing about some of these success stories that you're having. And as the next time I'm in Portland, I will gladly come visit one of the restaurants. I am a huge fan of Mexican food, so you have
Their food
a
is
customer.
great.
So, and I also wanted to talk a little bit about, because you have a couple of industries that you're really fascinated in, or industries that you're really focused on. And I'm curious to know, like, are there any industries or sectors that you're not really looking at, or sectors that you would say you kind of avoid, and why exactly, or what exactly, or kind of what's the rationale behind why you would avoid those particular sectors?
Sure. So I'm a big believer in the KISS principle. Keep it simple. I don't know. Stupid is not maybe a great word, but keep it simple. So
Keep it
we
simple,
start
silly.
silly. Okay, we'll
Yeah.
go with that. So we really start any lending discussion with a potential new borrower by asking two basic questions. How do you make money, and how are you going to pay us back? And if we can't understand the answers to those questions, forget it. We're done. And so we have had conversations with businesses that, I sat in a 30 to 60-minute conversation about how their business operates, and I didn't get it. And I just, said, I apologize. I just don't really get it. There's maybe another lender for you. So kind of our starting point is businesses that we can easily understand their cash flow cycle, business cycle, and how we're going to get repaid, because we're always thinking about what our exit's going to be. Kind of beyond that, the other kind of obstacle for us would be businesses where basically we don't want to be on the front page of a newspaper. So, we tend to do things that are non-controversial. So we don't do anything in the crypto space, which I don't have an issue with, but we just don't easily understand those. We don't do anything with cannabis, firearms, adult entertainment, kind of anything typically that banks tend to avoid too. We're willing to dig in deep, but there are some that are just not kind of an industry. I'd say the technology space, I think there is lots of opportunity, but it is difficult to understand. There are more specific private credit lenders that focus solely on technology. So we try to stay in our lane a little bit. And there's, we see so many opportunities that ones that might be a better fit for another lender, we're very happy to refer it elsewhere, because, frankly, we may get something in return in terms of a referral from them. So those are all, all things that we tend to stay away from. Not that it's bad. I want to make sure, listeners don't think these are bad industries, but these are ones that are just not always a good fit for us.
No, and I also agree that there's nothing that's inherently like wrong with those industries either. It's funny that you mentioned that technology is something that or technology. I'm assuming you mean like software as a service companies. Like those tend to be the ones that you avoid, because surprisingly, like in the VC world, it's the exact opposite. We see a lot of SaaS, software as a service, in terms of what VCs are looking for in investments. What would you say are kind of the reasons why like software as a service, at least for you, or in terms of private credit, private lending, may not necessarily be a good fit?
Yeah, the software as a service industry. Now, I'll caveat and
like
say
it's more of a curiosity, because it's like I just
Sure.
love that it's the contrast between those two.
Sure. So I'll caveat by saying we actually have a software as a service company in our portfolio.
Nice.
It's small. There's other compelling reasons that we did that loan. So I don't want to say the word, I don't want to be hypocritical here.
No, I mean, it's not necessarily a full-on no, but you really want to
Yes.
make certain you have
Yeah.
your revenue cycle down.
Yeah. Having said that, companies that are really relying upon kind of monthly recurring revenue model, which is kind of software as a service, a lot of times they come to us and they have recurring revenue, but not yet profitability or positive EBITDA. So that's kind of not an easy reason to say no, but if they're not positive cash flow, really hard for us to get comfortable with them. So that's what I see most of the time with those types of businesses. So there are, again, there's a lender out there for everyone, and I can think of a couple of lenders that do things that are all tied to recurring revenue model businesses. And I'd be the first to tell, one of these borrowers, hey, here's a couple of names that might be a better fit, because that's what they do. They stay in their lane, I stay in mine. And that way you get the best service and the best product from those who really know what they're doing the best.
That's so valid. And I think you've kind of demonstrated a lot throughout this conversation, how you try to be a true partner to the companies that you work with. And, I think that that's like an amazing and admirable trait. It's something that like when, again, like when you're working with money, when you're working with different companies, like, sometimes it's not just the lending or the capital that they need. It's sometimes they just need help and understanding from like a CEO or from a managing standpoint, how they can continue to grow their business, because not only so they can repay you, but so they can think about like future growth and trajectory. What would you say are kind of some of the like questions or some of the things that you like that you advise companies on, or like what are some of the kind of like key pain points that you help some of your portfolio companies with outside of the lending space?
Sure. I'll share with you kind of in full candor two of our partners that we work with. So Meriwether Group Capital is comprised of three general partners, I myself being one of them. My other two partners, one is called the Meriwether Group. So they are primarily a sell-side M&A advisory firm. They also do consulting work as well. And we share a lot of the same kinds of clients. And while there's not a requirement to use services back and forth, it's a very natural fit. Our third partner is the parent company of First Fed Bank, which is about a $2 billion bank based outside of Seattle, Washington. And they're a very traditional commercial and retail bank. So a lot of the things that we recommend to our clients are services that they offer. And as you kind of think about the spectrum of a business and their life cycle, there's need for equity and kind of consulting services, banking services beyond just lending. And then when there's, they're ready for a liquidity event, there's kind of the equity piece of that as well. And so between myself and my two partners, we can really encompass all those things. One of my business partners calls us kind of a modern day merchant bank, which is, really what that is. So a business can come to us for really a breadth of services beyond just a loan. And, that's something that we really enjoy and take a lot of pride in. I don't get compensated for things other than lending, but I take a lot of pride in getting, my portfolio partners in front of the right other partners that I think would be good for them. And these things all come full circle in life. And so that's why I enjoy doing it.
Again, like I think that that's absolutely amazing. And speaking of competitors, or speaking of kind of like additional like the private lending landscape, private credit landscape, given just the size of and scale of companies that you work with, who would you kind of, and also regional as well, what would you say are kind of some of the competitors that you identify in the space? And what would you say are some of your key differentiators, or how you think that you, not better is not the word that I'm looking for, but how would you say that you differentiate yourself from other private credit or private lenders in the space?
Sure. So, I won't name specific names here, but what I have observed is, first of all, private credit. So these are commercial lenders, not commercial real estate lenders, but private commercial lenders who do loans 500,000 to 5 million. I can off the top of my head think of a couple in the Western United States. So this is they're really, not that I want to say there's no competition, but it's a small and very fragmented space. I kind of think about, well, why is that? Am I maybe in the wrong business? Everyone else is not doing it. And, the reality is, like many businesses, as you start to grow, there's a need when you add people and real estate and things like that to start to move up market in lending. So I totally get that, but we love the small space. I think we have a really efficient model, which allows us to kind of stay small, stay in this space. And it's a kind of segment that we really like. The other businesses who kind of do some of these smaller private credit deals are kind of outside maybe the private commercial credit vertical, but I keep a deep Rolodex of companies that do purchase order financing, asset-based lending, recurring revenue model lending, private credit that's technology focused, commercial brokers who maybe have larger networks of this kind of stuff. So, as I think about a borrower, whether you're an individual or business, there's a loan out. If you want a loan, you can get one. I can almost guarantee it. But it's kind of, what are you willing to sacrifice in exchange? And there's a really broad spectrum there. And, I'm the very first to tell someone, because I'm kind of thinking more about the competitive landscape, we do get businesses that approach us that are much more bankable than they think they are. And I definitely see entrepreneurs that have kind of their heads down running the business. And, it's not up to them to determine, hey, will a bank make me a loan or not? They probably have a instinct, or maybe they were turned down for something before, but maybe circumstances have changed. And so I'm the very first to tell someone, hey, I think you can get a loan through a traditional bank. And while I maybe could make a loan and charge them more than a bank could, it's not good for anyone to do that. So while banks are not necessarily competitors, they're really complementary to us. SBA 7A lending is a very popular program that, frankly, many businesses that I talk to, if they have the patience and the timeline, could go down that path much less expensively. And so there's, again, this is a broad spectrum of the types of credit out there. So again, I don't worry so much about our competitors as to, who's the best fit for any one borrower.
Exactly. Who's the best fit? So when we think about other opportunities when it comes to private lending, I know we've kind of talked a bit about other competitors in the space, or we've talked about the overarching landscape of why it's important to find that's right for you. What would you say are kind of some of those criteria, not just for the companies that you work with, but maybe for those companies that down the road might be looking to work and partner with Meriwether Group? What should they be doing to get prepared to have a conversation with someone like yourself?
Sure. So that's a great question. So those that might not be a fit today, I really try to coach with, well, what will it take to get to a yes tomorrow or some point down the road? And, this is no big secret. Here's what, here is the magic secret of what banks really look for in commercial lending.
Listening.
Typically, there's three sources of repayment that banks look for. So most lenders, myself included, look for recurring cash flow is the primary source of repayment. So if they're not profitable or EBITDA positive today, that's really the number one thing that we're looking for to get them to a yes tomorrow. So as I kind of look at their projections, at what point they'll be EBITDA positive, that's the time to re-engage. Secondary source of repayment is typically liquidation of some form of collateral. So for example, we take a UCC filing on all business assets. We could be the only lender in the transaction, or we might be subordinate to a more traditional lender. So we need to understand what is the underlying collateral that will support our request. And in the event of a default, how would we liquidate and be made whole? So we're kind of looking for that too. And then the third source of repayment, or the tertiary source of repayment, is typically recourse to guarantors. So with the credits that we work on, in almost all cases, we have personal guarantees. So these would be, most of the businesses we work with are closely held, let's say 3 or fewer owners in the vast majority of the cases. And we expect them to stand behind the business just like they expect us to. So, what's their personal wherewithal is important to us also. Now, what I would share is that in not all cases do all three of those things be at kind of the best or optimal. But if there's a shortfall in one, we're certainly looking for a strength in the other two. And, that's what I coach our borrowers to is if collateral is weak, well, cash flow needs to be stronger, or you need more of a personal wherewithal. I would share with you that in actually 2 cases, we made loans to businesses where the first and second of those were not great, meaning a company was not yet EBITDA positive, had maybe a shortfall collateral, but what we recognize is the guarantors outside of the underlying business had outside sources of cash flow to help support the loan repayment. So we really look at things not just for the business, but really globally. So what are all the sources of cash flow to repay debt, not just the business? And that's, again, the bank doesn't easily get their arms around that, but we can dig deep and think about, okay, what are sources of repayment beyond just our borrower? And can the guarantors add something? And that often helps us get to a yes, whereas another lender might not be able to.
Nice, very impressive. And one or a couple other questions that I have. So Meriwether Group, you guys have been doing an amazing job. I honestly have been super impressed just from the due diligence work that I've been doing with you guys, and I'm a total fan. What would you say are the next steps, or what is Meriwether Group or Meriwether Hero Fund 2.0 in terms of strategy? Of course, and I'll emphasize the Hero Fund is an evergreen structure, but what other strategies are you guys potentially looking into with regards to private credit?
Yeah, so great question. So I'll kind of talk about the fund side itself now. So like you said, we're an evergreen or an open-ended fund. Today, we have about $14 million of assets under management spread across about 45 limited partners in the fund. This is really positioned as a growth, it's an income fund, not a growth fund. So this often can be very complementary to those who are looking for a little additional yield in exchange for a modest degree of credit risk. We have a target return annually of 10%. We pay a distribution every quarter. Since inception of the fund, we've beaten our target return every quarter. So really proud of that based on our pricing model and kind of how we manage expenses. While there's never a guarantee, we have a degree of confidence that we'll be able to continue to do that. So, in just under 2 years, we've gone from essentially $0 to $14 million. What I would share with you is that is not the optimal amount of assets under management for us to be able to service all the borrowers we would like to. So we have really strong loan demand, somewhat based on our reputation market, just demand in general, and our connections in the banking community. So I get just about a call every day for a new loan, and we try to do one loan a month. So you can do the math and you can think about how many times we're saying no to borrowers. So we'd like to be able to say yes, to more quality opportunities. So over the next couple of years, we'd really like to grow the fund to $25 to $30 million, maybe a little bit higher than that. We feel like that's the level that we can manage with the people we have in place today. We also believe that that gives a little bit better amount of credit risk diversification for our limited partners who don't pick and choose specific loans. They're investing pro rata across the portfolio of loans, and that gives, spreads it around a little bit more. And beyond that, our only limitation is our ability to find good investments in the form of loans to make. Right now, for private credit in the space we're in, loan demand is far greater, like I said, than our ability to meet it. We expect that will continue, and I have some thoughts as to why, if you want to explore that. So it's a good place to be, and that's kind of where I see us going. Now, having said all that, there's funds who do what we do that are $1 billion, $5 billion or more. That's not us. We don't ever want to be that size because we like the smaller segment. We think we can do it efficiently. And frankly, we want to be able to roll out the red carpet for our investors and our borrowers. Everyone's a big fish in our pond. So we appreciate that. I know every one of our investors. I know every one of our borrowers. We intend to keep it that way. So as I kind of think about our evolution, yes, we do want to grow assets under management, but we want to do it thoughtfully. I would share with you in great transparency, as you know, that we're a partner with Banrion Capital. We're super excited about it. We feel like one of the markets that we're really not tapped into, but we see opportunity is in the RIA space, which is, you guys are very focused, obviously, on bringing alternative investments and wealth managers together. We think that's a great model. I also recognize that the world of alternative investments is a broad space. Private credit is only one of multiple verticals in that. And if you're a registered investment advisor, where do you go to do the due diligence on all these? And so that's why we're super excited about the partnership, and frankly, then the opportunity to be able to service more limited partners that have those established RIA relationships.
Yeah, and I think, not trying to plug Banrion, but
you should.
Well, this is about you today, Jamie. So, but I think one of the things that kind of like we are also very excited about with our partnership with Meriwether Group is the fact that you guys work with those small, mid-sized businesses. And of course, there are, like you said, billion-dollar funds that we could be working with in the private credit space. But I don't believe that like the impact that they are bringing or providing to the table is nearly as, I think, measurable as I would say for the smaller companies that are in need of this capital or in need of that push in order to get to that next stage or that next phase of growth in their companies. And I think I wanted to tap on the point that you had mentioned earlier. So talking about interest rates and kind of future growth of where sort of like the private credit space is going right now. As you are well aware, anyone who has been following the news, interest rates have been going up to about their 20-year high. And so in order to combat inflation, and so how exactly, if anything, has that impacted your business model, or how has that impacted your ability to lend to these smaller businesses that, again, some people may perceive them as more risky or not willing to take on that risk now that interest rates keep going up? So cost of borrowing essentially is going up along with it. So just quick thoughts on that, or I'm curious to know like how that has impacted you, if at all.
Sure. So maybe I'll touch on this from kind of a pricing perspective and then a demand perspective. Maybe I'll do that in reverse order. So, I'd say right now it's a great time to be in private credit. I started my banking career in 1995. I think since then, we can look back at the notes, but I think there's been 4 recessions during that period of time. The typical cycle that I see banks go through during a recession is that when there's even a threat of recession, whether it happens or not, big banks get more conservative. This is very normal. And, it's not a surprise. It's not I'm not bashing a big bank, but that's just kind of what we see is leaning towards conservatism with these kinds of lenders. Normally when that happens, or in my past, when I've seen that happen, smaller banks, so think regional banks, community banks, they typically pick up the slack. Well, what's different this time around is really a run on deposit issue with some of these smaller banks. So think about Silicon Valley Bank, First Republic Bank. The number one reason banks have failed in the history of banking is credit issues. Neither of these banks failed for credit issues, in my opinion. They're really liquidity management ones. And so smaller banks that typically pick up the slack, in some cases are finding capital restraints, within themselves. So while they may want to be making more loans, they, in some cases, don't have the available capital to do it. Layer one more thing on top of that, which is COVID. So we saw in the onset of COVID, this phenomenon called the Great Resignation. If you look back through the data in terms of business formation, the onset of COVID, or the first kind of year, was one of the greatest periods of time for new business formation in kind of the history of this data. So while not all those businesses are successful, okay, fast forward 3 years later, some of them are, and some of them are seeking access to capital for the first time. So when you layer on top of, all this, more demand for lending, conservative or limited capital to lend from banks, where do you go? So here we go, private credit, which, today is, I think, depending on what report you look at, a $1.6 trillion industry forecasted to double over the next year or two. So that's kind of the space we play in. So then I'll kind of layer on top of that, then the interest rate environment, which is certainly a consideration, but really doesn't have that much of an impact on us. The reason why is we really set our pricing based really on a supply and demand model. We have massive demand and limited supply. So kind of do the math. We have an expected minimum return from our borrowers of at least 14% between kind of upfront rate and fee. That allows us to ensure that we can meet or exceed our target return to our investors of 10% annually. Just kind of that's how the math works. The reality is we're doing far better than that today. When interest rates start to go back down at some point in the future, there could be some impact to us, but really what would drive changes of our own pricing would be demand. And if there was, other private lenders who maybe do bigger things started to go kind of down market in terms of size of loans, or banks getting into the space, which I think is highly unlikely, but is always possible. These are kind of the things I think about. So, from a borrower's perspective, yes, we are expensive, more expensive than bank debt. But if you're a business who is trying to grow, you need access to capital. Well, where do you do that? You can sell equity in your business, which is far more expensive than debt and is dilutive to ownership. Or you could go down the debt path. And if you kind of maxed out your bank, or your bank has maxed out you want, some additional working capital to help you grow, what do you do? And that's kind of the need we fill.
Nice. And my last question for you today is, and I would love for you to just kind of talk a bit about in terms of how our podcast is called What's the Alternative? And so if you could give us kind of your pitch for why Meriwether Group, what would you say, what is the alternative, and basically what is Meriwether Group? So that way we can have that as well.
Sure. So, we're all about entrepreneurs helping other entrepreneurs. That's what we do. We feel like we offer on a risk-adjusted basis, a strong product. It's helpful to our borrowers. It's helpful to our investors. It's good for ourselves too. And we feel like we're filling an underserved niche that there's just stronger demand than the ability to fill. And we're really proud to be able to do that, and to do so in a way that helps those who want to invest with us an above market return.
Excellent. And everyone, thank you so much for listening to our podcast today. Again, my name is Victoria Bills, and you're listening to Jamie Shulman, managing partner of the Meriwether Capital Group. Jamie, again, thank you so much for everything. We appreciate having you on and learning more about the amazing work that you're doing in the private credit space.
Thanks so much, Victoria. I appreciate it.
The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Banrion Capital Management platform. As such, Banrion may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Banrion Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Banrion Capital trademarks mentioned are owned by Banrion Capital Management Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.